Many economists view financial markets as efficient, with prices incorporating all available information about future values. Behavioral economists say that model simply doesn't reflect how markets actually work. So are markets efficient? Welcome to The Big Question, the monthly video series from Chicago Booth Review. I'm Hal Weitzman, and I'm joined by an expert panel. Eugene F is the Robert R. McCormick Distinguished Service Professor of Finance at Chicago Booth. Well known for his empirical analysis of asset prices and for developing the efficient market hypothesis, he was the joint recipient of the 2013 Nobel Prize in Economic Science. And Richard Thaler is the Charles R. Walgreen Distinguished Service Professor of Behavioral Science and Economics at Chicago Booth. He's director of Booth's Center for Decision Research and co-author of the bestseller Nudge. His more recent book is Misbehaving, the Making of Behavioral Economics. Panel, welcome to The Big Question. Gene F, let me start with you. You came up with this efficient market hypothesis, so tell us briefly, what is it?
Well, it's a very simple statement that prices reflect all available information. Testing that hypothesis turns out to be more difficult, but it's a simple hypothesis in principle.
Okay. Richard Thaler, do you agree that market prices reflect all available information?
Well, like Gene says, it's easier to say than to test. And I like to distinguish two aspects of it. One is whether you can beat the market. That's the one most people are most interested in. And the other is whether prices are correct. So if prices reflect all information, then they should land on the right price. And we can separate those two questions because they're different.
Okay, but the basic premise about the containing the information is something you don't agree with then, it sounds like?
It's almost impossible to test that hypothesis, except through the two questions that I've asked. Can you beat the market? And are prices right?
Okay, is that right, Gene F? If you say that prices reflect all available information, it necessarily means that a price is right at any particular point in time?
That's the statement of the hypothesis, but it's a model. It's not completely true. No models are completely true. They're approximations to the world. The question is, for what purposes are they a good approximation? As far as I'm concerned, they're a good approximation from almost every purpose. I don't know any investors who shouldn't behave as if markets are efficient, for example. And there are all kinds of tests with respect to the response of prices to specific kinds of information, in which the hypothesis that prices adjust quickly to information looks very good. There are others where it looks less good. So it's a model. It's not entirely always true, but it's a good working model for most practical uses.
Okay, is that right? Is it a good working model?
Well, again, I think for the first part, can you beat the market? I think Gene and I are in virtually complete agreement, which is that's a good working hypothesis for any investor.
Does that mean you should assume, any individual investor should assume that markets are efficient?
Behave as if would be the way you'd put it.
Behave as if.
Well, yeah, certainly there's evidence going back to the thesis of Mike Jensen, who was, I guess, maybe one of Gene's first students,
right,
was around at the same time, who did a thesis on whether mutual funds, on average, beat their benchmarks, and after you account for their fees, they don't. That was in the 60s. It's been updated a zillion times, and you can quibble about exactly how to do it, but that's approximately true. So just investing based on fees is not a dumb thing to do, regardless of the nuances that Gene and I might get into.
Okay, but you talked earlier about in some cases, the model works, in other cases it works less well. And in your book, Richard Thaler, you talk about the 1987 crash, Black Monday. And you give that as an example of how prices are not right. The efficient markets don't really work. You say if prices are too variable, they're in some sense wrong. It's hard to argue the price at the close of trading on Thursday, October 15th, and the price at the close of trading the following Monday, more than 25% lower, can both be rational measures of intrinsic value given the absence of news. But isn't the idea that efficient markets are supposed to be unpredictable?
Yes, but unpredictable doesn't mean rational. So, you know, I have a 2-year-old granddaughter who runs around like crazy, and I defy anyone to use a rational model to predict what she's going to do next. So she will be unpredictable, but her behavior isn't well captured by a model of maximizing anything other than whatever she calls fun.
So is the market, does the market behave in the same way as your granddaughter?
Well, sometimes. I don't think anyone thinks that the value of the world economy fell 25% that day. Nothing happened.
So if markets were efficient, there would be a certain bounded level of volatility. So if
Well, in the absence, so it's not a day when World War III was declared.
But it was a time when people were talking about perhaps an oncoming recession, which turned out not to happen. So on hindsight, this was a big mistake, but it needn't have been. So in hindsight, every price is wrong.
Yeah,
but that's 2020 hindsight.
That's 2020 hindsight, and but what I would say is merely the big fluctuations that entire week. 2 of the biggest up days in history occurred that week, and 3 of the biggest down days, and nothing was happening other than the fact that people were talking about how markets are going up and down like crazy all over the world. So that's one indirect way that we can measure market efficiency. This was essentially the approach that was pioneered by Bob Shiller, who Gene shared the Nobel Prize with. And his argument was prices fluctuate too much to be explained by a rational process.
Right, and Gene Fama, is that right? That when there's a certain level at which prices just fluctuate too much,
Well,
there's too much volatility?
there's a test for that, and the test says that when we look at longer periods of time, the variance of the price changes should not grow like the length of the time period. If there is all of this temporary variation in prices, that's not rational. And in fact, that test does not indicate that there's temporary variation in prices. So you've got to kind of come up with a different test. Shiller's model was based on the proposition that there's no variation through time in expected returns. But we know there is a ton of variation in expected returns. So that kind of branch of testing people lost interest in because you really can't come to any conclusions. A straight test of whether there's temporary variation in prices says no, there isn't. You can't identify it. And another test, which would be, is there too much variation in expected returns to be attributed to rational behavior? Well, now you have to define what you mean by that, and that's terribly difficult.
But is your argument then that investors are constantly changing their view of the expected future value of the shares?
My view is that risk aversion moves dramatically through time. And in particular, it's very high during bad periods, and it's lower during good periods, and that affects the pricing of assets and then the expected returns you expect.
And so every time there's a stock market crash, people come to you, or they rubbish the idea of efficient markets and point to this massive volatility and say, doesn't that prove that efficient markets are wrong? And
doesn't prove that at all.
What it proves is what? Is that risk changes a lot very quickly?
Well, and information changes a lot through time.
Dick Thaler, let me turn to you. Bubbles. Gene Fama famously does not allow the use of the word bubbles, but I'm going to use it. Do bubbles exist? How do we define bubbles?
Well, I think it's hard to say. I'm going to present 2 examples, one of which is, I think, more convincing than the other. The first one is I have a graph that I think you'll show the viewers. It was produced by Gene's son-in-law, John Cochran. And it's a graph of house prices over a very long period of time in the US. And what it shows is that for a long period of time, house prices were roughly 20 times rental prices. And then starting around 2000, they go up. Depending on which measure you use, they go up a lot or they go up really a lot. And then they go back down after the financial crisis. Now, I can't use this graph to convince Gene that markets are inefficient.
True.
Because
the graph stops too soon.
Well, yeah, but we're not going to live long enough to.
No. I mean, if you continue the graph, it goes back to the peak.
Well, but.
So what's the bubble? The down, the up, the subsequent down?
Well, okay. So once again, we're in agreement, which is that studying data like this, it's impossible to know for sure whether something's a bubble. There are hints in that graph that prices seem to have diverged from a level that had existed for a very long time. They went up and then they went down. Was this because of irrational exuberance, Alan Greenspan's phrase? What we do know is that in the markets like Vegas and Scottsdale and South Florida, where prices were going up the most, expectations of future price appreciation were also the highest. And that could be rational, but I'm skeptical of that. And of course, in hindsight, it was wrong. But let me present another example, which is amusing at least. Have I told you about this one? The CUBA Fund?
No.
Okay, this is good. So there's a closed-end mutual fund that happens to have the ticker symbol CUBA. Now, closed-end funds have been studied for many years. They're a special kind of mutual fund where the shares trade in markets and the price of the shares can deviate from the value of the assets that they own. So this particular fund, although it has a ticker symbol CUBA, of course cannot invest in Cuba. A, that would be illegal, and B, there are no securities. So its holdings of Cuba are zero. And for many years it traded at a discount of about 10 to 15% of net asset value, meaning that you could buy $100 worth of their assets for $85 to $90, which is a good bargain. Then, if we look at the chart, all of a sudden, one day, the price skyrockets and it sells for a 70% premium. And you can probably guess what happened. That was the day that President Obama announced his intention to relax relations with Cuba. So a bunch of securities you could buy for $90 on one day, it costs you $170 the next day. Now that I call a bubble. Unlike the first case where Gene and I could argue forever as to whether those home prices were rational or irrational, I'm pretty sure Gene doesn't think that it would be smart to pay $170 for $100 worth of cruise ship lines and Mexican companies. And all through this period, there was no change in the value of their assets. So it's not like the market was anticipating some boom in the Caribbean. This is just a mistake.
Okay. Gene Fama, this is an anomaly, but it's also a bubble in your terminology.
Both.
Well, it's a one-day bubble.
No. it goes up and then it takes a year
To come back.
to come back.
Well, it drops most of that 170 the next.
Well, I mean, a few months later, it's still...
Anyway, it's an anecdote, not a, it's.
yeah.
There's a difference between anecdotes and evidence, right?
Okay, so as you know, I have lots of these anecdotes, like my paper with Owen on Palm and Threecom.
Okay, that one, right.
And so when, I mean, this was an example where a part of a company was worth more than the whole company.
That can happen, but
Yeah, but
because the rest of the company can be unprofitable.
yeah, but the rest of the company was actually the only profitable part in this case.
So I should
That
say
was-
for
that
more
was an
details on
example.
I should say for more details on that case, people can read your book Misbehaving.
Correct.
But the point here is you think
I don't deny that there exist anecdotes where there are problems. I don't deny that. It's just, for example, for bubbles, I want a systematic way of identifying them. In my view, it's a simple proposition. You have to be able to predict that there is some ending to it. And all the tests that people have done trying to do that, they can't do it. So statistically, people have not come up with ways of identifying bubbles. I think that there's a lot of identification of bubbles based on 20/20 hindsight, and it's very easy to do in that situation. For example, irrational exuberance, which but that was Schiller that takes credit for that. But if you actually date the time, the market goes up more afterward and never goes back to that point. So irrational exuberance never went away, if that's what it was.
So this is where we are. I mean, and why do I bring up amusing anecdotes? Which I agree, this is. It's a spec. And when Owen Lamont and I presented our paper in the finance workshop, presenting another one of these anecdotes, Gene and I got into a discussion of icebergs. And Gene's point was that, like, this is the iceberg. Yeah, that I can go find these cute little anecdotes.
this is the whole problem.
And, you know, okay, so little stuff can go wrong. And my argument is, and there's no way to prove which one of us is right, is, look, these are the few cases where we can test whether the price and intrinsic value are the same. And, you know, it shouldn't be that a small unprofitable part of a company is worth more than the entire company where the rest is profitable. It shouldn't be true that shares of the CUBA Fund are selling at a 70% premium. Now, you know, I go to these and say, look, if the market can't get this right.
Wait, there are other examples of cases where you can't test it. For example, pari-mutuel markets are a good example. You can test whether the odds are good predictors of eventual outcomes, and they turn out to be very good.
Well, they're very good, although there's something called the favorite long shot bias. So if you go to the racetrack, you shouldn't bet because they take 17%. But if you do, you want to bet on favorites because like 100-to-1 long shot will win one race out of 400. So the prices are correlated, and the deviations aren't enough to beat the 17% spread, but there are some anomalies.
I just want to press you there for a second. How do you define the bubbles then?
Well, I would say bubbles are when prices exceed a rational valuation of the securities being traded.
That's right, but what's the test of that?
Well, the only tests that are clean are these anecdotes, like closed-end funds, where we know the value of the assets and we know the price and we can see that they're different. For something like the real estate market, we only have a suspicion and we can't prove it, although I have some ideas I'm working on with one of our golf buddies to figure out how to predict when a bubble's going to end.
Okay, sounds like a good reason to play more golf. But to go back to the iceberg for a second, I mean, if financial markets are inefficient, and you're saying that there's more that we haven't seen, that's the point of the iceberg example, where are the biggest inefficiencies?
Well, again, it depends on which definition we're using. So where are you most likely to be able to beat the market? Smaller firms, less developed countries. But although even there, the advantage that active managers have is relatively small.
Okay.
But those to me seem like, that one you'd have to test whether that actually works. We have tested that. That one doesn't work. But things that are more systematically tested, that are indications of some degree of market inefficiency, are, for example, the accountants have long established that the adjustment of announcements to earnings is very quick, but not complete. It takes a few more days before there's a complete adjustment. Not enough to make any profits on, but so what? It's still a slower adjustment, so that's an indication that the market's not completely efficient. The whole process, the whole momentum phenomenon gives me problems. It could be risk, but if it's risk, it changes much too quickly for me to capture it in any asset pricing model. So that one gives me the biggest problems of all. So the point is not that markets are efficient. It's, they're not. That's just the model. The question is, how inefficient are they? I tend to give more weight to systematic things like failure to adjust completely to earnings announcements or momentum than to anecdotes, which to me seem less, they're fine, but they're just little things popping up. They're curiosity items rather than evidence.
But Dick Thaler highlighted one area where you do agree, which is about the value premium, that low price stocks tend to do better.
That one's unresolvable.
So, but you both have different explanations of why that's the case.
Sure.
So can you give your explanation and tell me what your
my
evidence...
explanation is that value stocks are just riskier than growth stocks. Initially, the people who thought that wasn't true thought that there was an arbitrage opportunity in value versus growth, that if you went long value and short growth, you'd get a portfolio that had a very low variance and a high return. Turned out that wasn't true. If you went long one and short the other, you got a net that had a very high variance. So it looked, smelled, and tastes like a risk factor, but you can't really establish that unless you can tell me why this source of variance carries a different price per unit than other sources of variance, because that's what you're into as soon as you deviate from the basic capital asset pricing model. You're really saying different sources of variances carry different prices per unit of variance. And the Fama French three-factor model was kind of the first one to put that into operation, and 20 years have passed, and people have been trying for 20 years to identify whether that's due to some taste factor or something people are trying to hedge against. And although I have a vested interest in saying, good, somebody's identified what it hedges against, I don't really find it convincing. The arguments on either side. So I think that's just an open issue at this point. That's why I say that issue is basically unresolvable, at least as far as the test.
So yeah, I pretty much agree with that. But Gene and Ken have gone now to a five-factor model where
we're still working on that. Maybe 4, maybe 5.
Okay, but
you could add momentum and go 6.
Yeah, there you go. And in my view, there was one rational model of stock prices, and that was the capital asset pricing model. And I think in a world of rational investors, the CAPM would be true.
No, that's false. But
that's what I think.
But there's no multi-period model that ever leads to the CAPM.
Well, in any case, it's certainly not true.
That's true.
And we have these other factors like size and value, and now profitability and investment. Now, I've looked hard to find the way in which value stocks are riskier than growth stocks and have been unable to find them. I agree with Gene that betting on that spread is a very risky activity. Any hedge fund that did that would have gone out of business in the late 1990s. But that doesn't mean that the explanation for the abnormal returns is due to risk. Nobody can prove that.
So what is your explanation?
I think that value firms look scary, and they get a premium for that.
There's another story that they don't have to look scary, they just people don't like them. And economists don't argue about taste. So value stocks tend to be low-performing companies who have few investment opportunities and aren't very profitable. And maybe people just don't like those. So that story, to me, has more appeal than a mispricing story, because mispricing, at least in the standard economic framework, should eventually correct itself. And it shouldn't keep repeating, whereas taste can go on forever.
Well, but so I would disagree with that.
Which part?
So I don't think you can call it taste. So
I don't know. I'm not saying I can call it that.
No,
that appeals to me more.
Suppose you say you like $20 bills, and you're willing to take 4 20s for 100. Now that's taste. Now I'm going to make a lot of money.
That's an arbitrage.
Yeah, well,
there's no arbitrage here.
So, but the question is, if the people who dislike value stocks, and that's just taste, and it's wrong.
It's not wrong. Remember, now we're economists. You're behavioralists. That's even worse. So you don't comment on people's taste.
Yeah, I do when they say that they like 4 20s better than 100.
That's an arbitrage. That's different.
Well,
suppose I tell you I like apples better than oranges.
Then that's taste.
Okay.
So
that's
look,
value stocks and growth stocks.
We're both.
I'm not arguing for it. I'm just saying it's a possibility.
Well, but look, we're both affiliated with asset management firms, and both of our firms invest, at least partially, in small value stocks. Now, we're hoping to earn high returns, and do. So.
Well, sometimes.
Sometimes, not all the time, or it wouldn't work. If we're buying those stocks because people don't like them, we're only going to make money if they change their mind. Some people change their mind. And so that's why the taste argument, I don't think there's any, I think you're more behavioral than me now.
I'm an economist. Economics is behavioral. There's no doubt about it.
Isn't that your point? That all economics should be behavioral?
Oh, but there's a difference. His point is
we have stopped just then.
No, wait. There is a difference, because yours is irrational behavior. Mine is just behavior.
Oh, no. I hate the word rational.
Oh, good.
So the distinction I make is whether behavior is predictable from a rational model.
Okay.
And I'm willing to include behavior that is not predicted by a rational model.
Oh, okay. No, I would agree with that.
And look, I think, at the end of my book, I call for what I call evidence-based economics, and I think that's what Gene does and has always done. There's no way, the point I was making about the 5-factor model or the 3-factor model is there's no way you can derive that from some axiomatic first principles.
No, you can't. It falls in the context of Merton's model, but you have not identified the relevant state variables that would give rise to it. And I think it's actually more complicated than that no one of these is really associated with a state variable. They're all just linear combinations of multiple state variables combined in different ways.
Right.
Which makes the problem very difficult to unravel.
But the way in which you and I are the same is we're both interested in understanding the world.
Right.
And, I have some prurient interests in things like the CUBA Fund, but at the main level, I think we would both like to know what caused housing prices to go up so fast and then back down, and
then back up again.
and then back. Well, yeah, certainly part of the way up, not not exactly in the same places, but and if those prices were wrong in some sense, then it would be good to know.
Absolutely.
And so,
Total agreement on that.
if I were the chair of the Fed or in charge of Fetty and Franny, if I saw places like Vegas and Scottsdale were in the 1990s, I would be raising lending requirements. You could borrow at, well, there were the, liar loans, but you could borrow at very low interest rates and very low down payments into what looks like a pretty pricey market. So
you're saying policymakers should use bubbles as a way to step in and intervene?
yeah, but very gently. It's not that I think that policymakers know what's going to happen, but if they see what looks disturbing, they can lean against the wind a little bit, and that's as far as I would go. Something we certainly both agree about is...
No, not on that one.
No. I'm going to say something I think we both agree about, is that stock markets, good or bad, are the best thing we got going. So nobody's devised a way of allocating resources that's better
Than markets in general.
than markets in general. We're in total agreement about that.
We're in disagreement about whether policymakers ever get it right, though.
Well, it sounds like you're asking the policymakers to step into the market that you just said was so perfect.
Almost surely will do more harm than good.
Yeah, well, the argument that whether the policymakers ever get it right, I think
No, that's a little strange.
Yeah.
On balance, whether they cause more harm than good.
Yeah, no, but if they listen to us, then
Then they'd surely cause more harm than good.
Gene Fama, you said earlier you're a behavioral economist. Has your thinking been shaped by the sort of behavioral science that Dick Thaler has pioneered?
No, but
Was the three-factor model a response to some of the work that Dick Thaler and others
absolutely not. It was a response to the data, basically. It's what we call an empirical asset pricing model. It has this vague connection to Merton's model, but it was really empirically inspired. Those were factors that were screaming at us from the data, basically. And we put them in there and got a lot of credit for it, but it really was kind of an obvious thing to do. And it's had a 20-year run, so we can't complain about that. That's as long as the run that the CAP-M had, so can't really complain. But
to your mind, has behavioral science, what impact has it had on economics?
I think every economics department is into it to some extent or another, right?
yeah.
It's still kind of what I'd call curiosity items rather than, in other words, 20 years ago I made this criticism of behavioral finance that it was really just a branch of efficient markets because all they were complaining about us. So I was like probably the most important behavioral finance person because without me there was no behavioral finance.
Well, you're the reference point, yeah.
I'm the guy to criticize, But I still think that's true. There is no behavioral asset pricing model that can be tested front to back.
Look, I think there's no asset pricing model.
Whoa, that's a really nihilistic point of view, though.
Well,
But you have said, Dick Thaler,
no
that you
theoretical one.
You've said that you referred to the efficient market hypothesis remains the kind of the standard to which your work is directed.
Yeah, that's true of all economic models. So, expected utility theory is the right way to make decisions under uncertainty. People don't. In my managerial decision-making class, I give them rules at the end of class. And one is ignore sunk costs, assume everyone else doesn't. And that's kind of my philosophy of life. I believe the rational model, and I think a lot of people screw it up, and that we can build richer models and models with a better predictive power if we include the way people actually behave as opposed to the way fictional creatures that are
The so-called econs.
econs that are, as smart as Kevin Murphy and have no self-control problems. I don't know anybody like that.
One of the criticisms that's made sometimes of you is that what you're pointing out essentially are anomalies, like the CUBA Fund. And there is no overarching theory which other people can then try to reject. So do you need a theory? Will there be a theory?
No, there won't be a new overarching theory. We've got one. It just happens to be wrong.
Like all theories, but
Yeah. So it's not going to be like the Copernican revolution, where having the Earth in the middle was clearly wrong, and having the sun in the middle was right. It's not going to be like that. It's going to be more like engineering. So physics in its pure form with lots of assumptions doesn't build good bridges. You need engineering. And that's what the behavioral approach to economics is. And I don't think it's really all that different than what Gene does.
Is this really an academic debate? You said at the beginning that you essentially agree about investing strategy, what regular investors should do. So is this a debate that really affects the typical investor, retail investor? Gene Fama?
I don't think, I think when Kahneman was asked after he got the Nobel Prize, how should investors behave, he basically said they should buy index funds.
Yeah.
So, that seems to be the bottom. But they come from it from a different perspective, because since they think everybody's irrational, the only way to make them rational is to have them tell them what to do that's possibly rational. Whereas I think the rational thing to do, because prices reflect available information, pretty much, is to be a passive investor. But my complaint about lots of the stuff that falls under behavioral finance, and this is not a complaint of him. I always say that he is very, he knows the psychology aspects of stuff, and he's always oriented towards that. But he has there are lots of acolytes of behavioral finance who are pure data dredges. All they're doing is out there looking for anomalies. They have no connection to anything in psychology. If you look at a behavioral finance NBER thing, it will be populated with those kinds of papers that are pure data dredging looking for anomalies. And that's, I think, I don't know, I think I'd cut them off the program if I were you.
Well, I'll agree to do that if we can cut the theory dredging.
But what about this idea that this may just be an academic debate, doesn't really affect individual investors? Or indeed, as you said earlier, both of you are involved with money management firms that seem profitable. So someone would say, well, you're coming at it from completely different perspectives. We're able to make money basically with the same strategy, as you pointed out. What is the big disagreement here?
Well, the strategies aren't exactly the same, and David Booth is a better marketer than anybody at Fuller and Thaler. But no, I think if there's a non-academic point about this, it's whether things like, let's say, the rise of technology stocks, in Gene's honor, I won't refer to it as a bubble, whether that was a misallocation of resources. And
On hindsight, it was. On foresight, not necessarily.
it was. And if the rise and fall of technology stocks was a bubble,
True,
then,
internet stocks, you mean? Not
essentially internet stocks. Although even companies like Cisco were.
But technology stocks are still
Yeah.
a good fraction of the market.
So, I mean, if prices can be off, Fisher Black said he defined an efficient market as prices within a factor of 2.
Fisher said lots of crazy things, though.
So that's my definition of market efficiency. And, you know, I have a Chicago Nobel Prize winner I'm resting on. And if that's right, then, you know, we had, during those days, a lot of our MBA students were quitting after their first year to go out and make their billion. And most of them didn't. So, and you know, the same is true for the housing market. And so I think these are important questions that are not just academic disputes, and they'll be very important in trying to understand the way the global economy works. Now, I'm not saying we can recognize them when they're happening, although I'm working on that. But I do think that we can have a pretty good hunch, and that solving that, a bubble detection committee would be highly useful if it were reliable. And we're not there yet. And just saying it's impossible, I think.
I'm not saying it's impossible.
Yeah.
Just saying it's
So if then we can agree on, it's hard to tell, except for my cute anecdotes like Cuba.
In general, it would be very useful to know to what extent all economic outcomes are due to rational or irrational interplays. We don't really know that. I don't
Yeah.
think we're
No,
close
this
to
is
knowing that.
this is
So
a point.
that's more. That's not just that would improve everybody's lives. More understanding is better than less understanding.
Okay, well, on that note, our time is up. This has been a fascinating discussion, and maybe we can do it again when you have come out with your bubble research. Look forward to that. My thanks to our panel, Eugene Fama and Richard Thaler. For more research, analysis and commentary, visit us online at review.chicagobooth.edu and join us again next time for another Big Question. Goodbye.